So good morning to everyone.
Recording.
Good morning.
Good morning. Good morning. Good morning. Good morning. Good morning.
So can you tell me, please, whether you can see the screen? Yes, you can see the screen. Perfect. So today we're going to start a course that's called Derivatives. This is a difficult course, and we're going to have a look at various derivatives types. We're going to learn how to price simple plain vanilla derivatives. And well, the syllabus of the course is available, but I hope that it is available from the study office. What is important? 50% of an overall grade is made out of your lecture performance. Every lecture we're going to have a short quiz, and that's why it is important that you have LMS, LMS available, and 50% of your overall grade is your final exam. Is interest rate swap? Well, to my opinion, all products simple products. We are not going to talk about structured products like look-back options, swaps with out-callable features, and so on. So we're gonna cover very simple things like option swaps, forward contracts, future rates agreement, and so on. Well, it looks like nothing changed. It just it's much better. So do you have any questions left? Okay, I hope you don't. So we're going to start with derivatives markets, instruments, and associated risks. So this lecture is important because after this lecture, you're going to have a quiz. I can share the lecture as soon as we finish through Zoom. It's very important that you take notes to try to understand what's going on. That's why I started the lecture with information about your overall grade. So first of all, if we like to talk about derivatives, it's very important to define this product. We call a derivative a financial instrument that is structured as a legal contract and derives its performance, its payoff from the performance of an underlying asset. So derivative transforms the performance of an asset. What is an underlying? Underlying is a traded asset, a commodity. So we have derivatives on equities, on bonds, on other fixed income securities and currencies, commodities. We can have derivatives on derivatives and so on. Even in our country, even in Russia, we have energy derivatives issued. I mean, they're not issued in Russia, but they're issued by Russian companies. As far as you know, the Gazprom has started to work with weather derivatives. So the value of an underlying asset is the source of risk because every traded asset price is volatile. So volatility of an underlying asset is what makes derivatives risky products. I hope that you have already covered financial markets and you know that there are several types of markets like primary, secondary. You know that there is a sell side, buy side. You know that there are spot market, forward market, and so on. So if you don't have this knowledge, have a look at any financial markets intro just to get familiar with basic notions. Market maker, dealer, broker, sell side, buy side, primary, secondary, and like these simple terms. So if we talk about derivatives markets, market makers or market dealers are investment banks, and other market participants are speculators. Most common strategies involves options trading, and futures trading. So individuals or small investment firms or hedge funds, they trade derivatives to achieve additional profit. So these operations involve a significant amount of risk. The person who purchases the derivative and holds it is said to have a long position. So when we say long an option, it means that this person purchased an option and paid a premium for a contract purchased. If we talk about the seller, this is the one who sold an option, received a premium. If we talk about the options market, and when we talk about stock or futures contract, we say that the seller holds a short position. As soon as we reach swap contracts, I will define the buyer and the seller of the swap contract. But when we talk about swap contracts, we basically don't say long and short. We say fixed and floating, or fixed and equity. But as soon as we get closer to swap contracts, we're going to have a talk about these two fixed and floating notions. So basically, when we talk about derivatives, there are two big classes of derivatives: a commitment and contingent claim. So what's the difference? If we talk about forward commitment, this is a contract that forces the two parties to negotiate in the future. So if two parties has already agreed on a price, the negotiation is a must. So they cannot opt whether to negotiate or not to negotiate. So forward contracts, futures contracts, and swap contracts, forward commitment contracts. So if you have enrolled into a swap contract, you cannot opt for negotiating or not. Contingent claim is different. It provides the right to the buyer and an obligation to the seller. So if I enter an option contract as a buyer, I have the right, but I don't have any obligation. If I enter an option contract as a seller, I trade my rights for a premium, or I trade my further commitment for a premium. I receive a premium today, but I have an obligation in future. So trading options means trading opportunities for premium. I hope today we will cover use of derivatives. I've got some more slides at the end of this lecture. But in brief, derivatives are used to transfer risk from one party to another, and mostly derivatives are used by market risk managers to to manage risk of credits portfolio, traded derivatives portfolio, and so on. So I mean, a typical investment bank doesn't trade derivatives for as a speculator. So we don't speculate derivatives. We mostly purchase derivatives to hedge our portfolios or credit portfolios. And we issue derivatives to cover our clients' needs, in particular structured financing. And that's the second way of use of derivatives. They serve as a source of customized financing. The banking business model is basically to get money for cheap and to slice this amount of money into small parts and to sell them for an additional premium. So that's the banking business. That's how it works for centuries. But if we talk about big corporations and their needs, they have very specific, they might have very specific need for financing, various currencies, various terms, long terms. So it's very common that credit portfolio credits issued to legal entities have longer maturities than individuals' deposits that might be used for financing. Thus you receive and thus you obtain a typical asset liabilities problem when you have your assets short-term predicted and you have your liabilities long-term. In simple words, individual have a deposit and an individual opens a deposit. An average term is like 1 year, maximum 3 years. But in fact, no one would like to have a deposit for like 5 years, up to 3 years. When we talk about legal entities, but firms and corporations, when these legal entities ask for credit, they require like 10 years term, 15 years term. And this is the key source of the need for asset liabilities management. When you have your deposits like 5%, so you pay your clients 5% yearly, and you use their money to finance legal entities. You sell this money to legal entities at, let's say, 10% interest rate, and you have your 5% margin. But bank, in this case, becomes very sensitive to interest rates. If interest rates go up, in this case, individual would like to have a higher interest rate. So imagine if you have your deposit 5% and today interest rate is about 10%. You wouldn't like to keep this deposit. You'd like to withdraw this deposit. And if existing interest rate is 10%, and the bank has already issued a credit line for a legal entity, and the interest rate is 10%, it means that the bank becomes a source of free money if the bank finances a legal entity at existing risk-free rates. So, and in this case, like market risk managers or credit risk managers, but mostly this is called credit risk, but risk managers trade derivatives to manage interest rate risk that arises from assets and liabilities, terms and rates. So asset liabilities management is what this thing is. So, and the third point, beneficial strategies that cannot be implemented with an online. Mostly it's about structured products. When investment banks issue products that depend on a basket of lines. Sometimes hedge funds use derivative strategies, and probably we're going to talk about these strategies later. We have lecture dedicated to options strategies, so we will cover these things later. Do you have any questions regarding use of derivatives? Okay, you don't. If we talk about derivatives markets, there are two big markets: exchange derivatives exchange like Chicago Board, and the second market, it has a larger volume and it's called over-the-counter market, the OTC market. So if an investment bank structures a derivative trade with a corporation, they don't go to an exchange. This derivative has a form of a legal contract. They have to report this trade in different countries. There are different ways how reporting should be done. But in fact, the contract is structured as in the form of a legal contract. Nobody trades for a contract or like a swaption contract on exchange. And we're going to talk about exchange traded derivatives during our second lecture. So what about exchange? Options, futures. These two types of derivatives are most, these contracts are widespread and traded at exchange. As for the OTC market, we've got a lot of various types. Options, swaptions, various types of swaps, different type of options like Asian barrier commodity options, look back options, and so on. So as far as we can say, if derivatives are used as a source of customized financing, the OTC market is expected to have a larger volume and exchange traded because derivatives are widely used as a source of, as I've already said, customized finance. So what's the difference between exchange traded contract and the OTC contract? Exchange traded contracts are standardized, and this standardization firstly contributes to the liquidity. If you have a standardized contract, you have an electronic means of trading. It's quite easy to purchase the instrument or to sell the instrument. So the second point is that some markets are, let's say, intense. Some markets, I mean derivatives markets. Some derivatives markets are not that liquid. If you go to the St. Petersburg Exchange and you have a look at US denominated contracts, and if you compare the St. Petersburg Exchange with, let's say, London Stock Exchange, you will obviously see the difference between volumes and the spread and contracts availability. So the spread basically indicates the liquidity of an instrument. The higher the spread, the lower is the liquidity of contract. So that's the difference between derivatives markets, exchange traded derivatives. But if we'd like to talk about, if we'd like to compare liquidity on exchange traded and liquidity of OTC derivatives, well, OTC derivatives are illiquid. If investment bank and a corporation negotiate a contract, it's like 99% that these contracts won't be sold because they are very customized, there is so many details that it's basically impossible to sell these contracts to any other party. That's the first reason. And the second reason that derivatives are used in big amounts of funding is issued with the OTC contracts, while one exchange traded contract costs like $100,000 or $2,000. I mean, exchange traded derivatives don't cost like millions of dollars. When we talk about the OTC market, it's quite common that one contract costs like has a notional of millions of dollars. That's why it's quite difficult to sell this contract to any other party. Like imagine that national biggest mining company is financed with national, let's say, mining company financing is structured with derivatives contracts. it's very unlikely that any other company would like to have the same structure of financing. So if we continue with the active markets and liquid instruments, we can notice that market activity can be described by number of trades and trading volume, well, as well as the spread. So while liquidity can be described by time required to sell an asset at its fair value, we have to distinguish market activity and liquidity. These terms are different. So as far as you can see, here I define market activity as by number of trades and liquidity by time required to sell an asset. What's the difference? Imagine imagine a desired contract, a desired bond. This bond is not on the market. Everyone would like to have this bond, but no one can buy it because no one sells it. So the market cannot be called an active market. As soon as this bond is offered, this bond is purchased immediately. So the instrument is very liquid because the time required to sell this particular asset is minimal. That's an example of liquid market, but inactive market. And that's why it's very important to distinguish these two notions: activity, market activity, and market liquidity. So do you have any questions regarding markets, market activity? Okay. So now we're going to focus on derivatives exchange and derivatives markets. So the definition of derivatives exchange is a market where individuals trade standardized contracts that have been defined by the exchange. What does it mean? If you'd like to trade, let's say, options, you go to options trading board like CBOT, Chicago Board of Options Trading. You can select from existing contracts that are defined by the exchange. You can select strike, you can select an underlying, you can select a date. Every option contract has its schedule. So some contracts are issued on Wednesdays, some are closed on Fridays, and so on. It's a very common thing for an option to be issued like a ladder. So you have an option with a strike, let's say 5, 5.0, 5.5, 6.0, 6.5, etc. So these parameters like strike, date, underlying are defined by the exchange. The exchange structures this contract, standardizes these contracts. So if you'd like, in my example, if you'd like to trade a contract with a strike, let's say 5.2, you won't be able, there's no such contracts. If you'd like to sell an option with exercise date like Tuesday, it might be impossible, because if the exchange hasn't issued this contract so far, you won't be able to issue this contract yourself. So when we talk about derivatives exchange, these exchanges look like Lego constructor. They have building blocks, and they build various contracts out of these blocks. These contracts have a certain level of customization, but they are not very flexible. Why am I talking about this? Because if you trade any type of derivative, you have lots of formulas, lots of math behind your trading, and your formulas or your online calculators or programs or Python or any other programming language built algo strategies can indicate specific parameters. And these parameters are not offered on the market. There's a deal breaker for some option trading ideas or some futures trading ideas, because you have an idea, but you don't have a suitable contract. So it's very important to consider contracts details, contracts availability, minimal size, maximum strike, and so on. So you cannot use contracts that doesn't exist. So if we talk about exchange traded derivatives markets, we have market makers like investment banks or hedge funds, and the speculators. So mostly, so hedge funds sometimes act as market makers, sometimes they act as speculators. Some small firms and individuals act as speculators as well. So market makers, they buy and sell almost simultaneously different prices. And they have these instruments available. And that's why they're called market makers, because they always have these instruments in stock. So the standardization, liquid market. So what is important when we talk about exchange traded derivatives markets? These markets are now highly regulated, and derivatives trading requires significant margin. So before you start trading any type of derivative on exchange, you have to place substantial amount of money as margin. We're gonna talk about this later in details. But if you sell a contract, if you sell, if you trade your obligation in future, it's very important that you will be able to meet this obligation in future. So the exchange requires margin to ensure that every market participant who has an obligation in future will be able to meet this obligation at maturity. And that's why derivatives exchange collect margin. And that's why derivatives trading requires significant amount of funds to be placed on a margin account. So do you have any questions about structural derivative markets, the derivatives exchange? Okay. So now we're going to focus on clearinghouses. So when we talk about derivatives markets, an exchange has a function of clearing. It verifies the execution of a transaction and records the participants' identities. So it's just who sold what to whom. That's clearing. Clearinghouse is responsible for settlement. So when a contract expires, it's very important that money between participants are transferred correctly. So in fact, money are not transferred between participants. Money are transferred between participant and the exchange, and these amounts are netted, and after that, this money is transferred to another participant. So if I have to pay you $2, you have to pay me like $3, and then I have to pay you $5, and you have to pay me $1 more because we have a lot of contracts. I pay you, you pay me, and so on. This, the clearinghouse will net these payments and will make the final settlement. So I will receive the final amount of money, and you will receive your final amount of money. Well, if we have, we will receive money if we have other contracts. If we don't have any other contracts, and you are my only counterparty, and I'm your only counterparty, I will receive and a certain amount of money will be withdrawn from your account, or vice versa. You will receive and I will lose a certain amount of money. And these operations will be calculated at clearinghouse. So derivatives contracts are cleared and settled overnight. And the settlement and the payment, you will receive your payment 2 days after, 2 working days after your contract expires or your contract pays you. So if maturity date is Monday, you will receive your money by Wednesday. And in fact, you will have them on Thursday morning. So the basic role of clearinghouse is to provide the credit guarantee. The same thing happens to traditional exchange like stock exchange. But when we talk about derivatives contracts, they are even more risky when than equity contracts, because if you purchase a stock and you hold the stock, you are the party that don't have to place any margin. When we talk about derivatives contracts, basically, the majority of contracts requires a certain amount of margin. If you like to, you can check the amount of margin on CBOT page. Just type in any searching engine, CBOT margin, and you will see a current margin requirements for derivatives trades. So to provide credit guarantee, clearinghouse requires a cash deposit, and sometimes this cash deposit is called the margin bond or performance bond, and sometimes some legal entities who provide financial services indeed issues bonds, and their counterparts have to purchase these bonds. If you'd like to deal with, let's say, a payment system, electronic payments like Visa, MasterCard, and so on, or if you'd like to deal with any exchange, if you'd like to deal with derivatives exchange, you always have to place a cash deposit. That's how these financial services that consolidates lots of participants and transfer money, that's how they work. They require a cash deposit and they keep it, and if anything happens for payment systems like Visa, MasterCard, if something means a fraud, if we talk about derivatives exchange, that's default of counterparty. So in case of something, the financial agency, the financial consolidating agency like exchange or payment system or any other, just takes this cash deposit and uses to pay out the debt of a defaulted party. So the key role of a clearinghouse is providing the credit guarantee. So when we talk about the OTC market, we can say that the OTC market is sort of an informal network, and any type of legally permitted contract can exist on the OTC market. That's mostly the dealer market. So no one, there's no investment bank that trades contracts like daily. Mostly participants are hedging their risks, bank hedging and alternative opposite transactions, and they pass the risk to other parties. So they just transfer risk to markets. I will say a couple of words about transferring the risk. So while exchange traded contracts are cleared and standardized, the OTC contracts are customized, and mostly we use ISDA and RISDA templates. ISDA, International Swaps and Derivatives Association, and they issue standardized contracts to be used on the OTC market. Standardized contracts on the OTC market are issued under ISDA, where in Russia we call it ISDA. So they provide like a template for the contract. And these standardized templates have all information that is required, and they are issued basically under the UK law, because it's very difficult to bring any derivatives case to the court under the Russian law. And that's why investment bank basically uses the ISDA contracts. Well, we have the Russian analog of ISDA. It's called RISDA, RISDA. It's basically ISDA translated to Russian, but in fact, and it's used between Russian counterparties. But in fact, regarding on these standardized templates, the OTC market has a low degree of regulation, while derivatives trades in Russia has to be the OTC derivatives trades has to be reported, but in fact, there is still no fine, no penalty for reporting without any details. So banks report their derivatives that they have on their balance, but they don't report any particular details of these contracts. And this makes the OTC market a bit obscure, and it obviously lacks regulation. So, and I like to focus on the most important point here, that participants are willing to hedge the risks, just in the middle of the slide. That participants are willing to hedge their risk by engaging in alternative but similar transactions. What am I talking about? When a legal entity and a corporation comes to an investment bank, they want to receive like a structured financing. They want to have fixed credit instead of floating, etc. So the corporation has a particular need, a need for particular financing. Investment bank structures a specific derivative contract to cover its new client business needs. So they issue this specific financing in the form of derivative. They price the corporation for the credit. They price the corporation for their work. So they have their commission. But in fact, after the contract is issued, an investment bank has a market risk on him. So if I issue, could you please popular derivatives products. Okay. So after the contract is issued, the investment bank has all risks associated with this contract. Imagine in any country, imagine, let's say, the country biggest mining corporation, the country biggest railway company, or any corporation that is called like the country biggest. It is very difficult and very pricey in terms of regulations for any bank to have risks associated with big companies on their balances. And that's why investment banks, after issuing a derivative contract that covers a big corporation need for financing, try to issue a similar opposite rate or to sell this risk to the market. What does it mean to sell the risk to the market? They can use some small size contracts with similar risk parameters. So they just slice big contracts into smaller contracts and trade them. It's very difficult to sell a big derivative risk with exchange traded contracts. So the bank tries to sell these small contracts on the OTC market. So as for derivatives, so I've got a question. We've got a question. Could you please enumerate popular derivative products which is available in Russian banks? So if we talk about products that are available to standardized OTC products, today we have, first of all, I think we have energy products, main energy derivatives that are linked to oil and sometimes gas. So we have typical. So the typical online is interest rate or oil price, or euro is not very typical online. So we have euros, but in fact, the euro is not a very typical one. Ruble, Russian ruble, USD, oil, that are the most common online. If we talk about products, well, I think that now we have credits with built-in options. We have swaps. Well, I think that swaps and options are most common products. Swaps, options, and forwards are most common products. If we talk about standardized derivative products, we have now some a kind of a structured products renaissance, and lots of structured products like equity out-callable swaps are issued on the market. Several big legal entities issued these equity out-callable swaps. That's the product when you have a basket of equities, and this product pays you if the performance of the worst equity is not worse than. So if you have 4 equities, the performance of the worst equity should not be lower than a threshold level. So these 4 products, these 4 groups of products like swaps, options, and forwards, and out-callable swaps are the most common products. As for the rest of the market, look, we have national rail services. We have national air carrier. We have mines. We have companies that export, that import goods. So all these companies requires their specific needs to be covered. And then if you trade like Japanese cars, you are interested in hedging risks associated with Japanese yen. If you import FMCG goods from Europe, you are interested in simple options and forwards on euro. So there are lots of different types of products. And a typical derivatives portfolio of an investment bank, a big investment bank, may have hundreds of counterparts and thousands of different derivatives trades. So do you have any other questions about contracts and so on? Okay, so now we're going to talk about risks at derivative markets. So primary risks are quite natural. We have market risk, we have liquidity risk, we have counterparty credit risk, and interconnection risk. So market risk is interest rates, FX, equity, commodity. Like if interest rates increase or interest rate decrease, if equity price drops, if commodity price increases significantly, all these aspects affect market risk. And market risk can be hedged, even with a perfect hedge. But I hope that you know that a perfect hedge means that you reduce your expected interest to a risk-free rate, and you reduce any level of risk you take. That's the perfect hedge. So, however, market risk can be hedged with derivatives contracts. Derivatives risks are hedged with derivatives contracts or just having the underlying. What is important? Risk and amount of risk is tightly bound to an expected level of return. The lower is the risk, the lower is the expected return. If you'd like to take market risk off, you will receive risk-free rates. That's how it works. As for liquidity risk, is mostly managing terms of your obligations, your assets, and your liabilities, in fact. But because in fact, liquidity risk is the risk when you cannot sell an instrument in the market for a desired price. So the time of selling, you expect to sell an instrument in an hour, but you have to wait like a couple of weeks to sell the instrument. And while you keep on waiting, you cannot meet your obligations, and you can be claimed a defaulted counterparty. That's how liquidity risk works. So managing liquidity risk is mostly linking assets and liabilities terms and keeping a certain amount of funds in required assets. I mean, if a bank requires a certain amount of euros by a certain date, liquidity risk management implies purchasing futures contracts, purchasing euros, the asset, to be able to meet the obligation at due date. Counterparty credit risk for the OTC derivatives markets is the risk of a default of a counterparty. So imagine a bank has, or any company has a swap contract and expects a specific payment, or expects a currency to be sold with terms of a forward contract or any other transaction, but the counterparty defaults, and the bank or the corporation cannot just enter the trade they expected, or even more, they lose their money because they have exchanged notionals, or they have made their payment, and so on. So counterparty credit risk, in brief, it's risk related with the default of the counterparty. The interconnection risk is a new notion that has appeared after the crisis. The interconnection risk implies that big corporations, banks, and retailers, and producing companies, and all other sectors, and insurance as well, are tightly bound. And after a default of any big market player, there are going to be a series of defaults of the counterparts. So the interconnection risk is the risk of simultaneous default of several big market players. So here I've got a very simple example of how derivatives risks are managed. So imagine a corporation A that buys an OTC derivative from dealer B. Before the expiration date, corporation A wants to terminate the position. So they don't want this position anymore because of probably their business model has changed, or probably the risk has been eliminated elsewhere. So Corporation A can return to dealer B and ask to sell a derivative with identical terms as an opposite derivative. They can try to sell the derivative to a different dealer, or they can sell similarly identical derivative to a different dealer. In this case, Corporation A removes exposure to the underlying risk. But in the second case, they leave two transactions open. Sell the derivative to a different dealer, or sell similarly identical derivative to a different dealer. In this case, they have two transactions open. The first one, the initial one, and any of these two consecutive transactions. So some risk that one party would default remains. It might happen that the dealer B defaults, and in this case, the Corporation A is left with a sold derivative to a different dealer, or so B, if B defaults, B cannot meet its obligation and it won't pay A. If it won't pay A, it means that A, in the second case, won't be able to pay to a different dealer. In the third case, when A sold a similarly identical derivative to a different dealer, we have absolutely the same case. If dealer B defaults, the company A will have to pay out the trade out of its own funds. And there is a notion that's called a modal risk. That's risk of applying inappropriate model. And if a corporation structures a derivative trade themselves and they sell this product to a different dealer, this third opportunity involves a modal risk as well. They issue a new trade, so they always have the risk that the payoff of an initial trade will differ from a payoff of a similarly identical trade. So so as far as we have derivative contracts that are used as sources of specific financing or hedging operational risks, we do understand that corporations are very sensitive to these products. And that's why exchanges play an important role in risk mitigations. So exchange allows its participants to meet counterparty credit risk by using the central counterparty as buyer to every seller and seller to every buyer. So counterparty credit risk is the risk of the default of a counterparty. When market participants trade on exchange, they use exchange as a central counterparty, which is expected to never default. There had never been any central counterparty default. So clearinghouse is a legal entity that acts as a central counterparty, as a buyer and seller to every market participant. They manage credit risk, that's counterparty credit risk, via collecting margins. So every market player has to place initial margin and maintenance margin to continue its exchange operations, and this margin will be used in case of any counterparty default. So sometimes exchange traded contracts are used by banks and other regulated financial entities, because banks and other regulated financial entities don't have to reserve any funds for trades that are that have a counterparty, that have a central counterparty as a counterparty. In short, in simple words, if any bank has a derivative on its balance, they have to include this derivative in various reporting forms, and they have to reserve a certain amount of money because regulating bodies believe that derivatives are risky, and banks have to cover their derivatives positions with cash. So creating big reserves means leaving cash unused. Banks don't want to leave their cash, their funds available unused, and sometimes they prefer exchange traded derivatives because these derivatives don't require any reserves. They are not that burden for any bank balance in terms of regulation. So this was the final slide of our first part. I suppose we'll have a break, and our second part is dedicated to types of derivatives and options contracts. So do you have any questions? Okay, I see you don't. So could you please, while will be having your break, could you please check that LMS is available to everyone, please?
Excuse me.
Sure.
Do we have a test now or not?
You will have your test after we complete this part. This
Okay.
part, types of derivatives.
Will we have a deadline for this test today or until the end of the week? Maybe.
This is a very simple multiply choice test, and you will be given 25 minutes. We will start at midday during the lecture. This is going to be a part of a lecture.
Okay, thank you.
You're welcome. So we have a question. Would the test be conducted in regular LMS or smart LMS? I have an access to the same LMS that was used last year. So I suppose that's a regular LMS. So this system. So let's continue with types of derivatives. So as far as I've mentioned before, we have forward commitments, that's an obligation. Forwards, futures, and swaps are forward commitments. So a forward contract is defined as an OTC derivative contract in which two parties agree that one party will purchase an underlying. This party is called buyer. The buyer purchases the underlying from the other party, which is called a seller, at a later date at a fixed price they agree or when the contract is signed. So the forward contract price may differ from a future contract futures or futures with absolutely the same terms, but this issue is not subject of our course. But if you are interested in forward and futures prices difference, you can have a look at this, this feature. This is a very typical question for any quant interview or any structural interview, the difference of a forward and futures price. So we have spot contracts. Spot contract is an agreement to buy or sell an asset today. And we have a forward contract, is an agreement to buy or sell an asset at a certain time and at a certain future time. Thus, these two types of contracts are used to define prices and curves as well. So if I know forward prices, forward interest rates, like I can lend you $1 today for 1 month, for 3 months, for like half a year, or I can lend you $1 for 1 month in a month time, or I can lend you $1 in a month time for 3 months. So the first case is a spot price. The second case is a forward price. And the same thing we have with forward contracts. I can sell you 1 barrel of oil today for like $100. This is a spot price. I can sell you 1 barrel of oil in 1 month time for $105. That's forward contract and forward price. So the buyer agrees to buy the underlying on a certain specified future date, and the buyer is called a long. The seller is called a short. So forward contracts are not traded on the exchange, while futures are exchange traded contracts. Mostly forwards are short-term contracts, 1 month, 3 months, 6 months, and 1 year's maximum length of a forward contract. It's very important to note that one party in a forward contract is usually a financial institution, and it's not very often when forward contracts are traded between two counterparties to corporations. As soon as you understand from the nature of this contract, no money changes hands when the contract is initiated. So if we agree that I purchase $100 from you on December the 12th, it means that I will pay you rubles for these US dollars on December the 12th. You're not going to give me any money. I'm not going to give you any money at the moment. So no money changes hands at the contract initiation. Do I need to explain why no money changes hands when the contract is initiated? Or that's quite clear? Okay, that's clear. So if we agree that I purchase 100 US dollars 1 month later, and I pay you, let's say, 72 rubles for 1 US dollar, we both believe that the price is fair. And that's why we don't exchange any payments. We both believe that 72 rubles per 1 US dollar on December 12th is a good price. So there are two big types of forward contracts. They can be deliverable or cash settled. So non-deliverable or cash settled forwards implies that if we have crude oil forward, we are not going to have this oil. We're gonna have cash payment that is equal to the price of a barrel of oil. Sometimes these non-deliverable forwards are called contracts for difference. But the most common, I think, that a cash settled or NDF. And sometimes the forward can settle by delivery of the underlying asset. So when do we use forward contract? Sometimes forward contracts are used by companies that require any asset or by companies that produce any asset. The common thing is these companies are willing to lock the future buying price or selling price of an underlying asset. So they'd like sell oil or cattle or gas or whatever by the fixed price, or they'd like to purchase this asset at a fixed price. If the idea is locking the future price, why do we have non-deliverable forwards? That's quite easy, because sometimes a corporation needs an asset that is not traded, and a proxy asset is used. So if you use any specific type of fuel, you'd better purchase a forward on oil because oil is a proxy for any type of fuel. Well, it is not always a proxy, it's more or less a proxy. Or any production material like silver, for example, can be used as proxy for silver produced elements of machinery. Or so silver is used in production, and sometimes corporations just need silver, but sometimes they need something that is produced by companies that extensively use silver, and they can use these metal as a proxy. So that's why we have a market of deliverable contracts and non-deliverable contracts. So do you have any questions remaining regarding forward contracts? Okay, you don't. And we are moving to a futures contract. So futures contracts are standardized contracts. They are created by futures exchange and they're traded on a futures exchange. So the idea is the same. Two parties agree that the buyer will purchase the online and the seller would sell the online at a later date at agreed price. What's the difference? Well, the same thing here. No money changes hands when the contract is initiated, but the exchange has a daily setting of gains and losses to protect market players from a counterparty default, from a counterparty credit risk. And that's why trading futures requires ability of maintaining daily margin accounts. So just to trade futures, you need to have free funds that can be placed on a margin account upon exchange request. These margin calls guarantees the fulfillment of the meeting of their obligations of an exchange. And that's a very important thing. Probably you do remember spring after the corona, when oil futures, then there was a case with difference in prices between sweet oil and crude oil and Brent oil. And due to margin calls, a lot of funds of market players here on MOEX were wiped out. I will describe this case later, but the idea is that don't trade futures contracts if you don't have available funds. And I'll get back to this oil oil margin call later in the future, in some future lectures. When we will talk about commodities prices, contango and backwardation, and all these things, we're going to have a talk with this exchange margin call accident. So, futures contracts, as far as you have already understood, they're specialized versions of forward contracts. They are standardized by exchange, and they're very liquid contracts. and due to daily margining, they minimizes an exposure to counterparty credit risk. That's a strong side. And a weak side is that these standardized contracts cover a narrow range of underlying assets, a narrow range of times to expiration, over delivering settlement conditions. So they can be barely used for any specific financing or something. They are mostly used as a form of fixing a price for a specific asset. So if I need US dollars or fuel or coffee or any other material to produce my goods or something, any raw material, I can use a futures contract to fix the price. So liquid, standardized, narrow range of available underlyings used by corporations to fix a price for any raw material or currency or energy. So do you have any questions regarding futures? Okay, so we're going to talk about futures contracts details later, and have a special lecture dedicated to futures. I will have a closer look at these contracts. So I'd like to say a couple of words about daily settlement of gains and losses. So while the futures price is an agreed upon future underlying asset price, the contract price may differ. So if we have, if we agreed that I purchase $100 at 72 rubles per $1 US, and imagine that tomorrow, like on Monday, we have $1 at 80 rubles. In this case, these contracts, like 72 rubles per US dollars, will change its price. The same if we have 60 rubles per $1 US on Monday, the contract 72 US dollars in 1 month time will change its price. So the futures price in our case is 72 rubles per $1. The future price is an agreed upon future underlying gas price. The settlement price is the price the clearing house determines an average of the final futures trades of the day. It has nothing in common with the futures price. They just try to find out what is the actual price of an asset, of a stock, of futures. This marking to market is a daily procedure for any exchange. So all contracts are marked to the settlement price. So if we continue with the given example, our futures contract implies that the future price of $1 is 72 rubles. At the same time, other market players sell and buy other futures contracts, and they can decide that a good price at the same date is 73 rubles per dollar. Another futures contract will imply 71 rubles per dollar. So different market players have different expectations, and the exchange collects these prices. They take these prices in futures contracts and they calculate the expected price. And all contracts are marked to this calculated settlement price. So if futures are cash settled, this price will be used for delivery then, if this contract contracts will live and they keep on. So if you have these contracts expiring today, you won't undergo mark-to-market process. You will have delivery or cash settlement or something. If your contract doesn't expire today, this contract is marked to market and the margin is calculated according to the price of the futures contract that is received through marking to market procedure. So the idea, we look at different futures contracts, we find out what's the market expectation of the price, and we mark to market existing futures contract to understand an amount of margin to be placed. And in a forward contract, with the entire payoff made at expiration, we don't have these daily rebalancing or repayments procedure, and a loss of one party can be large enough to trigger a default. And that's the key difference between forward contracts and futures contracts. If you use futures contracts, you can make it's quite possible that you won't be able to make margin call, and this will trigger a default. But for this particular case, you must have a very large position in futures. And it's quite possible that an exchange just won't allow you to have to concentrate this position, as they have their limits on counterparty, on currency, and so on. And they just won't allow any market player to concentrate a huge volume in one hand. And that's why futures, in fact, cannot trigger a default. They can trigger losses, inability to meet margin requirements, but they cannot trigger a default. While a forward contract that is not marked to market daily can trigger a default. So imagine you have an asset. If you check its price daily and you repay the difference or you get the difference daily, it's quite unlikely that a daily change would trigger a default. If you have an asset and you leave it and it's marking to market, is your own responsibility. It might happen that one day you will have a look at the asset, when you will have to enter the forward contract as a counterparty, will find out that you are unable to meet your obligation, and this will trigger a default. So that's the difference, that's the business difference, and the difference between futures and forward contracts from a market risk manager perspective. So do you have any questions regarding this, this difference? Okay. There is a significant difference between futures margin accounts and equity margin accounts. So every margin account involves the extension of credit. So a market participant deposits part of the cost of the stock and borrows the remainder at a specified rate. Futures margin account implies that both parties deposit a margin, initial margin, and the remainder of the price is not borrowed. So that's the difference. And as for the maintenance margin, that's the amount of money that each participant maintain daily, is persists in both markets. So what is important that when we talk about futures contracts, losses and gains are collected and distributed to respective parties. And initial margins are not refunded, and additional margins are collected, and all these things make futures exchange a very trusted entities. They never default. So now we are turning to swap contracts. So basically, swap is an OTC derivative contract in which two parties agree to exchange series of cash flows. So one party pays a variable series that's determined by an underlying asset. Asset implies rate, price, or something, spread, just any variable, and another party pays a fixed series. So we can have interest rate swaps. One party will pay a fixed rate, and another party will pay floating rate linked to any indicator. We can have currency swaps. We can have currency interest rate swaps when you have interest rates in different currencies. We can also have various types of swaps like equity swap. One leg is fixed, one leg is linked to an equity. we can have commodity swap. One leg is linked to a commodity, another leg is fixed, and so on. So basically, you can have anything on a floating swap leg, like any asset. So these contracts is an OTC contract issued mostly under ISDA template. So two parties agree on online, number of units of the online, payment schedule, and notional the exchange at the initiation of the contract. So a very brief scheme of a typical swap contract. So imagine a corporation that borrows from a bank at a floating rate. The corporation and a corporation would like to have a fixed rate instead of floating, and when able to better anticipate its cash flow needs in making its interest payments. So to convert a floating rate loan to a fixed rate loan, the corporation enters a swap contract. So as far as you can say on the scheme, the corporation, in fact, pays fixed swap payments to a swap dealer, receives floating swap payments from swap dealer, and just passes these floating payments to a lender bank. Fixed rate is high, and this is the payment for getting rid of uncertainty, getting rid from floating payments. And swap contract is structured to fit the terms of the loan. So while the loan has an actual balance, the swap doesn't have such a balance that one party owes to another party. The swap has no principal, while loan has a principal. It has a balance of sorts that's called the notional principal. And the notional principal initially matched the loan balance. So we are talking about this scheme. We have a loan and would like to structure a swap to use this swap contract to get rid of floating payments. So if we have a loan with only one principal payment, the final payment, it will be matched with a swap with a fixed notional principal. If we have an amortizing loan, so the principal balance declines, we will have a swap with a pre-specified declining notional principal. So in fact, when we initiate a swap contract, we settle it, we set its parameters to make this a part of this swap, a floating part of the swap, resemble a loan payment structure. So the notional amount of the swap is not typically exchanged. So we just put down like the notional amount of a swap, like $1 million, but in fact we use this $1 million to calculate our payments. This is the notional. I don't pay you $1 million, or you don't pay me $1 million. We sign in the contract $1 million, and we calculate our payments, our fixed or floating lags based on this notional, and this notional can be amortizing or fixed. So the credit risk of a swap is lower than the risk of a loan, because when we talk about a loan, we have money that is given to a borrower. When we talk about a swap, no money is given before the first payment date, and the swap payments are structured as follows. At the first payment date, we compare two legs. The fixed leg owes like 100. The floating leg owes 105. These two payments are netted, and the floating leg will pay 5 to a fixed leg. At the second period, the second payment date, a fixed leg has to pay 100, while the floating leg has to pay 98. And in this case, the fixed leg will pay 2 to a floating leg. And that's how a swap contract that's our cash flows that are generated by swap contract. So the only money passing from one party to the other is the net difference between the fixed and floating interest payments, as described. So do you have any question regarding these payments, the swap payments? Okay, and now we will have a look at these financial instruments closer during our lecture. So that's just an introduction. And now we're going to talk about contingent claims, about options. So any contingent claim provides one party with the right, but not the obligation, to engage in a future transaction on terms agreed upon in advance. So, as I described this contract before, one party pays to receive the right to buy or sell an underlying asset, and another party receives a premium, and this party trades its future right for a premium. Long or investor or buyer, this is the first side. So investor or buyer or long, because this party pays money. Short or seller or writer, that's the party that receives the payment. That's a very common strategy in options trading when market participants write options with various strikes, and they believe that an asset will, the option will never be in the money, and they are willing just to receive a premium, and they expect that they will never meet their obligations. They expect they just will receive money, and no one will ask them to sell the asset or buy the option or whatever. So the writer's profit is the premium, the writer's loss is nearly unlimited. We're going to talk about various types of option strategies later. So there are exchange traded and OTC traded options. There are American options, European options. Well, in fact, there are Asian options, there are Bermudian options, and other exotic options. But we will have a look at American options. They can be exercised at any time up to the expiration date, and European options that can be exercised only on the expiration date. And we're gonna focus on European options mostly. And as for various exotic contracts, if we have some time left during the options lecture, we're gonna talk about some lookbacks, barriers, and other exotic types of options and their use. So while option is a contingent claim that can give you the right or that can incur a liability, we have two types of option. We have call option. A call option gives the holder the right to buy or to call an underlying asset by a certain date for a certain price. We're not talking about European options, but the Americans or Asian or Bermudian are the same, but the period will differ. As for a put option, the put option gives the holder the right to sell the underlying asset. So the price in the contract is known as the exercise price or strike price. So I like to buy $1 at 72 rubles in 1 month time. If I'd like to pay a certain amount of money for this opportunity, I can purchase an option, a call option on US dollars with a strike equal to 72. The date is the expiration date or maturity date. The sum the option buyer pays the writer is called the option premium. And at the moment, the option premium is the present value of the cash flows that are expected to be received by the holder of the option during the life of the option. So the premium is like a fair price. If you sell me the option at 72 rubles per $1 and you ask me to pay like $3, $3 is an expected cash flow from this operation. And we both believe that $3 for this contract is a fair price. So we use the following symbols to denote the expiration date, the price of the underlying, the exercise price or the strike price. So if at expiration the price of the underlying, we are talking about the call option now. If at expiration, the price of the underlying how to evaluate option premium. This is an introductory lecture, and we're going to talk about Black-Scholes and stochastic differential calculus and everything else within the course. So this is a very introduction. So, so we use the following terms, and if at expiration, the underlying value is greater than what the long would pay to obtain the underlying. In this case, the option is in the money. So I would like to exercise the option because I like to purchase a US dollar and pay 72 rubles per dollar because the market rate is 80 rubles per dollar, per $1 US, for example. The option is in the money. If the rate, if the market offers 60 rubles per US dollar, the second case, the price of the underlying is lower than the exercise price. The option is out of the money. I wouldn't like to purchase US dollars for 72 rubles from my contract because I can purchase a cheaper US dollar and pay just 60 rubles per $1 US. And if we have 72 rubles per $1 US, exactly what I have in my option contract, we say that the option is out the money. So here we have formulas. They are very simple, but basically the basic logic. A call option payoff to the call buyer, the call option payoff to the call seller, and the profit. To calculate the profit, we have to consider the premium paid. So have a look at these formulas, please, and we're gonna study an example. So max is just the maximum of, in fact, it's not a formula, it's just logic that's written in the form of a formula. So here we've got an example. Consider a call option with an exercise price equal to 150. The option was selling at 15 US dollars when the price of an underlying was 140. So a call option with an exercise price equal to 150. If I pay 15 US dollars, I can purchase an underlying, I can call an underlying and pay 150 US dollars for this underlying. The current price is 140. So the price of the underlying at expiration is 160. What is the value at expiration? And what is the profit for a call buyer? The value or the payoff for the call buyer. So if I have 150 US dollars price in my contract, and I can say that the same asset is traded at 160. What's the payoff? I exercise the option. I pay 150 and get an asset. At the same moment, I go to the market and I sell the asset and get 160. What's the payoff? I will have $10 left. But what's the profit? If I have purchased these products for $15, I don't have a profit. I have a $5 loss. We intentionally don't speak about time value of money here. I don't explain how the strike price is defined. I don't explain you how the premium is defined. So we're just starting a very basic thing, the logic, the core logic. Do you have any questions regarding this example? Okay. So these two pictures illustrate the call option payoff and the call option to the buyer and to the seller. So the call option, I'm the buyer. I like to execute the option, sell an asset that I received for cheap and get an additional amount of money. That's my payoff. The higher the price, the greater is the payoff, the greater is the value. For the option writer, the case is different. The writer received a premium, and this person is willing that no one actually would come and execute the option. And if anyone would come and execute the option, the writer will have to purchase this asset from the market to fulfill the needs of his counterparty, to fulfill his obligations. So the seller receives a premium and is willing that no one would purchase an option, and is willing that the price won't increase. We have a price here in x-axis. For the call buyer, the case is an opposite. So look, losses of a call buyer are limited while profits are unlimited. Call option seller profit is limited while losses can be quite high. The put option gives the holder the right to sell the end line. We have the same symbols, the expiration date, the price. If the underlying asset market price is lower, what the short have to pay for it, the long would execute the right and sell the asset to the short. Once again, put option gives the holder the right to sell the underlying asset by a certain date for a certain price. Like, if I have a put option, I can sell like my cup of coffee by a certain date for, let's say, $5. If I'm the put option seller, I have an obligation to buy a cup for $5. If I'm an put option buyer, I pay premium for an opportunity to sell. If I'm a put option seller, I receive premium. I trade my future opportunity for premium. I receive premium today, but I have an obligation in future. So if an asset price drops, a put option buyer would like to execute the option. If these cups cost like $3, I would definitely like to purchase the cup, to sell the cup for $5. If the price increases and cups cost like $10, I wouldn't like to execute the option. I would like to sell my cup at the market for $10. So we've got formulas here. The same, they're not in fact formulas, they're just logic. Whether it is profitable to sell or it's not profitable to sell. And if the operation is done, what's the overall profit? So we have to consider premium. And an example, consider a put option with an exercise price equal to 150. The option was selling at $15 while the price of the underlying was 160. So weird numbers, I think. I have to correct them because it's very unusual that a put option lives further than this, but as a study example, that's just fine. Put options are executed as soon as the price equal to the exercise price, to the strike price effect. Okay, so as a study example, the price of the underlying at expiration is 120. The strike is 150. The option is in the money. So I can use the put option and sell for 150 something that is sold for 120. So the payoff is 30. But what's the sign? The put option seller, the one who sold the option and received a premium, will have to pay these $30 difference. These $30 difference are taken from the option seller. So the seller's value is minus 30. The seller has to pay 150 for something that costs 120. So minus 30 US dollars. But the option seller has already received 15 US dollars premium. So an overall profit, or to be exact, an overall loss is equal to minus $15. The profit is minus $15 or the loss is $15. So do you have any questions regarding these examples? So yeah, we've got payoffs, the same thing. As far as you can see, put options limits profits and limits losses. for buyers and sellers, both. So if you don't have any questions, we'll have to go to LMS at the moment. So could you tell me, please, whether you can see lecture 1 to quiz within the LMS? No. Yes. Yes. So those of you who don't see the test, could you please refresh your page? No to yes, sure. So if you have any questions regarding the test, I mean, it doesn't work or something, please note that as far as I understand, you're not allowed to get back. You have 8 multiple choice questions and 4 very simple, 4 simple options questions. Do we type? No, you have that's strange because derivatives var is unpublished, so lecture 1 to quiz the only one that's left. And for the student that has already tried at 11 derivatives variant 1, so sorry, but I have to delete this test because this is not a test, in fact. So thank you to everyone. If you don't have any questions, you are free as soon as you finish your test. So if you have any questions remaining, don't hesitate to type your questions in chat, or I have to wish you a pleasant weekend and leave you. Okay, so no questions. Many thanks. Have a pleasant weekend.